Welcome to our Taking Stock video for the week ending the 5th of May 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Equities Analyst Daniel Ortisi to stream to you all things share market. Great to have you on board again, Dan.
Another busy week, certainly can, so lots to talk about today.
Definitely. But just before we get started, a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts tables presented shouldn't be relied upon as a guide for future performance. Well, Dan, it's been an eventful week, as you've said. It's May's upon us now. We've had surprise interest rate hikes, retail sales data, and bank results. They've all contributed to the market volatility. Interestingly, though, much of this volatility has been influenced by the large cap stocks. And you can see this using our advanced charting tool, which compares the S&P ASX 20, which is the large caps index, and that's in black, compared to the small ords index in green. Over the last few weeks, the ASX 20 has dropped by more than the small ords.
Absolutely can. And from an investing standpoint, this is certainly a promising sign for growth investors and active investing compared to passive investing. Over the past year, passive investing strategies such as ETFs have become popular as investors move towards the safety of those large cap stocks on the back of heightened macroeconomic risks around things like inflation and rising interest rates, like you've mentioned. But in recent months, there has been a recovery in growth stocks as the market anticipates now a peak in interest rates. In addition, a better than expected first quarter US reporting season has certainly helped garner renewed interest in growth sectors such as technology and healthcare. You can see with the chart on screen, which shows the average margin of beats has improved certainly from the prior quarters.
Yeah, very interesting dynamic that's playing out right now, Dan. The outperformance of those growth stocks can also be shown in the following chart, which displays the ratio of the MSCI Australia Growth to Value Index. As you can see, the ratio has risen since January, meaning that growth is outperforming value. And this dynamic has also helped support the performance of the Lincoln managed funds and Stock Doctor Star Stocks, with Star Growth stocks outperforming the market by about 1.7% over the month, returning 3.1% in April.
Yeah, it's great to get some good performance back on the board. And speaking about interest rates, Kian, the RBA announced an unexpected 25 basis point hike in the cash rate this week, which sent markets tumbling on the day due to those stubbornly high inflation rates. This will no doubt put further pressure on financially weak businesses, that is those with high debt levels and little cash flows. Currently, 3/4 of the ASX of listed stocks are financially unhealthy. And only last month, authentication software provider IOUPay went into administration following a fraud case, along with being unable to pay down its debts and liabilities.
Yeah, the environment is certainly challenging for those what we call zombie companies. But in addition, rising interest rates are beginning to have an impact on retail spending as well, with no growth reported in the March quarter. We are cautious on this sector, especially companies that are exposed to those household goods, clothing, and footwear. And just this week, auto and outdoor retailer and borderline Star Growth stock and Star Income stock, Super Retail Group, reported a slowdown in its like-for-like sales and rising margin pressure from higher wages, rent, and energy expenses. Not surprisingly, though, the share price reacted negatively following the rally over the last few months. A gross dividend yield of about 8% looks attractive, but we are monitoring the sustainability of that dividend very closely, especially given that free cash flow and dividend forecasts are expected to decline this year.
That's right, Kian. And moving over to another income stock, National Australia Bank, which is currently on a gross dividend yield of around 9%, is expected to go ex-dividend on the 10th of May. A significant adverse share price reaction to its first half 23 result is certainly contributing to this attractive yield as the share price has fallen. Investors appear to be disappointed by the fact that growth in the bank's net interest margin, which of course is the difference between its loan rates and its deposit rate, has peaked earlier than expected. This could lead to negative earnings revisions and dividend revisions, so please look out for our final assessment, which should be arriving next week.
Yeah, the bank results have certainly come hard and fast, but ANZ also released its result this week with net interest income below expectations, although they did increase their first half dividend to 81 cents per share, unlike National Australia Bank. And that translates to a gross dividend yield of close to around 10%. But we'll have more on this in our next episode. Now, onto a standout performer this week, online lottery ticket reseller Jumbo Interactive. The company is a star growth stock and star income stock, and its share price soared even though management did pare back their earnings guidance after the softer jackpot volumes in the second half.
Yeah, that's right, Kian. And the share price has been under some pressure in the last year. So I think the market had priced in, very low expectations into this update. The company is expected to reduce its marketing costs as well to offset some of that missed revenue. Additionally, a rise in lottery ticket prices sold through Jumbo's online platform should help sustain the company's earnings growth and also return on equity profile.
Yeah, certainly an opportunity there on Jumbo, but onto another positive announcement. Lender's mortgage insurance provider, Helia Group, they released a trading update which was materially ahead of consensus expectations. And our analyst Ryan Lim, he was quite excited about this as well. Now, this star growth stock and star income stock continues to benefit from an environment of elevated lenders' mortgage insurance policy cancellations. And that's due to the spate of refinancing activities and also lower claim rates and investment gains from its bond portfolio. However, Dan, there was a muted reaction on the day.
Yeah, a little bit to our surprise there, Kian. And what we think is that the surprise RBA cash rate hike on Tuesday kind of introduces a higher degree of delinquency risk to the Australian property market, and that might have dampened some of the optimism for Helia's quarterly update. That gross dividend yield of around 16% certainly looks attractive, and we think this is achievable for the year on the back of higher earnings expectations, and together with over $300 million in excess capital on the balance sheet, which of course will support any shareholder returns.
Yeah, I wouldn't be surprised if a special dividend emerges from here as well for this stock. But turning our attention to the week ahead, Dan, the bank reporting season will wrap up with Westpac on Monday. Well, both National and ANZ, they are expected to go ex-dividend during the week. So that share price volatility could certainly create some opportunity there. But meanwhile, Helia Group, we've just spoken about them. They'll be hosting their AGM on the 11th of May. This week, in Under the Microscope, we look at Computershare, a firm that provides issuer services for listed companies and debt securitization services via its corporate trust divisions. Now, investors would recall that the core investment thesis for Computershare is premised on its ability to generate additional interest income from held cash balances during the provision of their services, which is referred to as margin income by management. Now, while the stock is well positioned to earn additional marginal income, given the rising interest rate environment, management did issue a downgrade to its financial year 24 margin income guidance by about 13%. That was materially below consensus expectations, and that caused the share price to react poorly, falling by about 5% on the day. So, Dan, can you take our members through the drivers of this downgrade?
Yes, certainly, Kian. Really, the main factor for the miss in FY24 margin income is predicated on these lower cash balance forecasts. These were impacted by a recent decline in debt securitization volumes sparked by the regional banking fears in the US, such as the collapse of Silicon Valley Bank. Additionally, softer IPO and capital raising volumes have contributed. As such, consensus have also revised their FY24 earnings down by around 5%.
Yeah, that's interesting, Dan. To help members understand this, debt securitization is the process of packaging a wide range of debts, such as from home mortgages, into a single security to be sold to investors. Now, investors have become more cautious about these mortgage-backed securities, and that's led to lower demand and volumes. So with this headwind in mind, why have we decided to retain the company as a borderline star growth stock?
Yeah, so there seems to be several factors which really drove our decision on Computershare's status retention, Ken. But at the core of this decision is that Computershare's earnings profile is still intact, and it's in fact scheduled to grow over 100% in FY23 and then continue to grow in FY24. In fact, sensitivity analysis also suggests that the business can generate an extra $25 million in profits from a 25 basis point lift in the cash rate as well.
Yeah, interesting that the RBA did increase cash rates this week as well, and that should help it somewhat. But even though financial year 24 margin income has been downgraded, it is still around 7% higher than financial year 23 figures. So, and the other thing is this announcement also makes us question, though, whether those forecasts are reliable, even though it is well covered with 12 analysts. But to build more certainty in the outlook, management did mention that they are locking in the high interest rates at around 50% of their cash balance over the next 6 years. And this compares to their current hedge position at only 36%. So certainly locking in the high interest rates here.
Absolutely, Kian. It's also reassuring to know that Computershare still has potential for growth despite near-term headwinds. The current discount to valuation and low double-digit PE levels may present an opportunities for investors seeking exposure to rate-sensitive stocks. But members need to understand that these figures will change on the back of interest rate fluctuations, like you mentioned, Kian.
Yeah, let's not forget the exchange rate impacts as well, Dan, with the majority of its revenue generated in the US. So profits will be driven by changes to the Fed funds rate overseas as well. Despite the rise in bond yields and interest rate expectations over the last year, the gross dividend yields for equity markets remain at around about 2% premium to cash rates. However, with economic growth expected to slow, a useful question for members this week is, how do you differentiate attractive dividend-paying stocks from yield traps?
That's right, Kian. And to remind investors, yield traps are companies that display attractive yields, mostly due to significant share price falls. These companies are susceptible to earnings downgrades, are at risk of cutting dividends in the future. Hence, investors should pay attention to the earnings revisions under Golden Rule 3 and share price sentiment under Golden Rule 4. These companies are often financially unhealthy businesses with too much debt as well. Given that dividends are paid out in cash to shareholders, it is important for us to look at a company's ability to generate cash. Hence, for industrial and resource companies, we look at the trend in free cash flow, which is the net cash flow from operations deducted by capital expenditures.
Yeah, good point there, Dan. But we need to be careful here. Declining free cash flow may not necessarily mean that a dividend is at risk of a cut. A company could be making an abnormal investment to generate stronger cash flows into the future. And they could also have ample cash on their balance sheet to help sustain those dividends in the near term as well. This is where qualitative assessment is also crucial in understanding yield sustainability.
Absolutely, Kian. And we also note that free cash flow is not a useful measure for infrastructure, utilities, and REIT companies because their high capex requirements means that free cash flow is often negative. For these stocks, assessing the operating cash flow is a more reliable measure because it represents the cash flow coming in from operations, such as net rental income for REITs, which is often paid out in full. Within the financial sector, cash flow figures are not useful in assessing dividend sustainability because they could include cash from outside the traditional business operations, such as customer deposits or loans. Hence, for financials, members should look at the trend in earnings per share and compare it to the dividend per share. Also check that the payout ratio is consistent with historical trends.
Yeah, very relevant points there, Dan. And I hope our members find this question useful. As always, feel free to contact our analyst team or attend our Lincoln Live sessions on Monday if you need further clarification on any points mentioned here today. Well, that's all we have time for today. Thanks, Dan, again for coming here. I know you're very busy. We've just had the resources quarterlies coming through, and the resource stocks are doing quite well, aren't they?
Absolutely. There's never a quiet week in Stock Doctor Ken, so it's great to be back on.
And also, I'm very excited. Next week, our Managing Director and Chief Investment Officer, Tim Lincoln, will be joining me on Taking Stock for an interesting episode as we assess the bank reporting season in full. So make sure you don't miss out. And of course, if you find our service invaluable, don't forget to refer your family or friends to receive 200 off our membership. And you can do this by clicking on the tab on the top right on Stock Doctor. Well, to summarize, we are beginning to see signs of resilience among growth and small cap stocks, even with unexpected interest rate hikes. However, we cannot be too complacent. Make sure you focus on those financially healthy businesses with manageable debt levels, strong free cash flow, and of course, sustainable dividend yields. Take care and have a happy, healthy, and prosperous week ahead.